Hi, my friends. Let's talk about what's going on in the market. But before we get into that, I just want to spend a couple minutes talking about why it's so hard to answer the question, what are your rates? And this is a perfect opportunity because Freddie and Fannie just came out with new adjustments. So I wanted to show you what those are, take you behind the curtain so it makes more sense. So let's start there. We're going to Google LLPA Fannie Mae. And it's the very first top one here. And these are all public knowledge or public information. Now, the reason why we have LLPAs is because they're trying to assess the risk of a different borrower. So higher credit score versus how much down payment, if it's going to be a condo, if it's an investment versus a primary. There's literally 30 different criteria they use to assess a risk. It's a little bit like going to get life insurance where they're checking your blood pressure, your weight, if you're a smoker, things like that. It's the same idea. So if you're a higher risk, they're going to have more of these adjustments in there and it's going to have a higher rate. So let's give you a couple examples here. And this is also showing you the new ones that are coming out. It's actually coming into effect on May 1st, but most investors already baked these into their pricing. Every lender, so the Wells Fargo, Chase, us, we all use these same things so that we can be a conventional mortgage. So it doesn't matter which lender you have, it's always the same. Now the difference is they're servicing, and because we do our own servicing, we're typically very competitive, if not the best, with rates when I compare them with the other rates that are out there. So, but that's really the only differences in rates is just that servicing part of it. So here's an example. The credit score, the FICO has 2 more tiers than it used to have. It used to be the highest was 740, but now there's 2 other tiers, and so you have to be at a 780 to be in the top tier. If you have a 760, you're actually in tier number 2. Then the top here is showing the loan to value. So if you're less than 5%, like you're a first time buyer and you're 3%, this is your column. So as your credit score decreases, your rate increases with 3%. And then it goes along with less down payment or more down payment, it changes what your score is. Now there's a couple really different adjustments here that really don't make sense compared to what they were before. And even with a really good credit score, your adjustments is worse with 20% down than it is if you have 5% down. So it's kind of good news for first-time buyers, but a little bit weird if you have more down payment. So that's one of the things. Now there's a couple other really big differences. This DTI ratio, debt to income ratio, if it's greater than 40%, there's going to be an adjustment. This is new. And I can tell you that a lot of my clients have a debt to income ratio over 40, so that's going to make a little bit of a difference. So, you're looking at it and going like, why is my rates this? It seems kind of high. Well, now you know. These things are priced right in here. Now, when we go online and we're looking at rates, let's use Mortgage News Daily. They're a pretty good place for us to look and see where rates are. But do you see any of these adjustments in here? They're not here, are they? So when we see a 6.97, is that for someone with a 760 score or a 700 score? Is this 20% down, 5% down? What is this? It doesn't tell us what the differences are. And that's what makes these things so tricky when you look on here is they're not showing this. Then if you scroll down, which most people don't even do, you can see that there's even more of a range here. And if you compare these, you can see there's a lot of differences in the rates and even some with points, which I think is a little bit deceitful because it's not really comparing apples with apples the same way because they're putting that in there. And that's kind of the problem when you're looking at advertised rates is a lot of times they're putting in discount points that make it a little bit, you're just focused on the rate here and you miss that part and you're spending a lot more money than maybe you need to, especially when you're planning on refinancing soon because that discount point will disappear once you refinance and it doesn't make a lot of sense. All right, so that's enough of that. Now, I wanted to jump into the housing market really quickly because the rates have been going higher. There's a lot of people that are like, oh, we're going to go into a bubble. I just want to show you a couple things. This is hyper local. I'm going to use Minnesota. Oops, not Minnesota. let's see if I can get this in here. Minnesota, and let's do Anoka County. So we can just see what's happening in Anoka County. Now this is a scorecard that they do on a regular basis. I could print this out anytime if you want to have a copy of it. I can give you one that's for your county so you can look at it. You can see what the median price is, a lot of the information here. But I just want to point out a couple of things. They change this on a weekly basis. So, I watch this all the time and see what's happening. This is telling me, are we in a bubble? What's going to happen? Why do we have this pressure? All that's kind of explained in here, but there's a lot of detail. So maybe in another video I'll go more into detail. But here's a little bit. The median price in Anoka is just under $350,000. The appreciation in the last 63 years, if you just averaged it, was just under 4%. So every year your home on average increased by 4%. Now the forecast for this year is 2.18, which is a little bit below average, but that makes sense because the rates are a little bit higher right now. But they are expecting rates to go down, and when they look at the forecast overall, we are going to be pretty close to 3% per year. This is a cumulative 15%. So the cost of waiting, if you said, you know what, rates are really high, I don't want to wait, or I'd rather wait and buy my house later. Here's the thing. In 5 years, this $350,000 house, you're going to be paying $403,000 for it. So you have lost that. Or another way of saying it, you buy your home now, you're going to gain that much equity during that time period. I know a lot of buyers that probably are kicking themselves when they should have bought maybe a couple years ago when all that appreciation was happening right here at the 7% per year. They would be having a lot more equity. But it's not that it's a bad time to start now because we're still gaining in equity. It's not going the other way. It's maybe decelerating a little bit for just the short term, but as the rates go down, it will. Now, here's the reason why I know that. Look right here. The household formations, 4,400 household formations. First-time buyers, 35 of those are first-time buyers. Actual homes being built in Anoka County, less than 2,000. What we actually have and what's needed is we almost need 50% more just to cover what we have. Now, affordability. You're saying, well, how can we afford it with the rates so high? How can we afford it? In our area, the median household income is $83,000 in Anoka County. When we look at what it costs for a house for $350,000 with the current mortgage rates, we're still at affordability index above 100. If it's above 100, then the average person should be able to afford that home based on the debt to income ratios. So like I said before, if you're really interested in this, I'd be happy to print one out for you that shows you for your county, or if you'd like to have an updated one, every once in a while we'll go back into this because this is really good information for us to use. Okay, so let's go back into the bond market, see what's been happening. Let's do a look back first. We're going to go into the last, let's see if I can get this a little bit further. Okay, 2 year. So in 2021, there was a lot of demand for mortgage bonds, meaning there was investors that were interested in buying the mortgages on the secondary market. That's what the bond market is, okay? As inflation started getting worse, because mortgages are a long-term investment, that meant investors were less and less interested in putting their money in here, and that is why it started to deteriorate. Now, as the bond market deteriorates, the rates must increase to attract the investors because they don't want to put their money there so much. We have to increase the rate for them to have a return. So inflation is the arch enemy of rates. So this is what we're seeing in 2022, a rapid decline through the year and actually peaking in the middle of October. And this is where we're seeing these 7% of our interest rates. Now, as we got past that point, we started right here, November 10th. There was a really good inflation number that came out. The CPI came out, and it just made everyone, hallelujah. We had, I don't know how many weeks, maybe 12 weeks that we had of bad reports, and that's where we were just declining all here. And it came out, it looked a lot better, and it was doing pretty good. and we've had a little bit of decline in December, but it kind of recovered, and January was doing decent. We were kind of almost back into the fives, definitely in the low sixes for most people's rates. But then on November 2nd, there was a jobs report that came out. Now, this jobs report, in my opinion, had some weird adjustments, seasonal adjustments, and they were adding immigrants and some other things in there that didn't quite make sense the way they were doing it. But the next one that comes out will probably not have those in there because they've already baked those ones in there basically. But because that number was so much higher and because they're still showing inflation is a little bit higher, it has been decreasing and declining. Now, some of the reasons why the inflation numbers are still showing lower or still showing high is because of the housing market, because it was high before, and then when they survey and when that's happening actually, they're a little bit different from each other. So there's a lag time in there. There's also a lag time as far as like just the jobs number in general. So as those start to come along, we're going to start seeing inflation start to drop. And we're going to see probably going back here. Now, it is going to be a bit of a roller coaster, but we need to be, cognizant of the fact that it's going to take a little while. But like I said before, or I've said lots of times to people, is the higher rates are actually a little bit of our friend. They're causing a lot of the buyers, especially maybe the investor buyers, to say, now's not the time to buy anymore. So they're moving out, so there's not quite as many buyers as there were. It's giving the first-time buyers, other people, a chance. There's still a little bit of a window of opportunity there to have some seller concessions in there, which I've talked about in other videos before that you could do. There's still a lot of advantages with this, with the higher rates. It's given us an opportunity here. And when the rates go back down, we'll rewrite that mortgage. We'll get it down so that they'll have a lower mortgage afterwards, and then you'll win twice. You'll get the home at a less price, and you'll also get your rate at a less. Now, things change all the time. Every week on Instagram, I'm going to do a quick little update just to show you what's going on. That's why I've been telling people, go to Instagram, look what I'm going there. You need to be watching this. I am watching this for all of my friends that are refinance or have a home they bought in the last year and their rates are a little bit higher. I'm watching for them. I'm making sure we relock them at a better rate at the right time and not beforehand. But if there's ever any questions, my door is always open. I would love to chat with you.